Are we on the brink of a market crash? Patrick Bet-David says yes, and the time to prepare is now. If you think your portfolio is safe, think again. This crash could change everything. Stick around because today, we're diving deep into Bet-David's urgent advice to safeguard your investments and come out ahead when the market takes a nosedive. Hey everyone, welcome back to the channel. If you're here, you're probably concerned about the market's unpredictable future, and you're not alone. I'm your trusted guide to making sense of the financial world, and today, we're tackling a topic that's on everyone's mind: the looming market crash and how to protect yourself. In this video, we'll explore Patrick Bet-David's warning about an imminent crash, the strategies he suggests to protect your portfolio, and why diversification might be your saving grace. Stick around, because by the end, you'll have practical steps to not only survive but thrive in a downturn.
Remember a couple of years ago how everybody was talking about that a market crash was coming? Everybody's like, oh my God, what if it happens? What if it doesn't? Now everybody's talking about it's going to be soft landing. There's not going to be any recession. And there's one thing that people forgot about, the saying, only the paranoid survive. This is coming soon. That starts this month. A month before election, there should be a recession in America. So people are now, it's totally fine. Look at the market. It's near all-time highs. But is it really? If you were to pull out the top 7 stocks, when you see the numbers on this, it's staggering. And on top of that, there is an indicator of when a recession actually hits. And it isn't while we're raising interest rates, the Fed. It happens after we stop raising rates. And wait till you see how long it takes for the market to crash. And by the way, I got a bunch of other data to share with you, but I've learned one thing for sure. Having been in the financial industry since the day before 9/11, only the paranoid survive, and those who are way too confident are typically wrong, and those who are way too cocky are also typically wrong. So here's U.S. interest rate hikes in the history of America. When we raise rates, we have never raised 4.88 percentage points as quickly as we did in the States. Nothing comes close to the 22 to 23 of 4.88. But what does this really mean? So if we look at the balance sheet of, this is pretty much the quantitative easing balance sheet, that shows how much bonds the Fed is buying. The M2 money supply shows how much money is circulating in the economy. So you notice, look how historically it's gradually climbing, but it's nothing that's sudden. Then all of a sudden, boom, we feed the economy, the market, with trillions of dollars we're not accustomed to. And we don't have another case study for somebody to say, well, here's what's going to happen. Well, it's totally okay. Well, don't worry about it. Based on what? Based on what case study can you speak so confidently saying nothing's going to happen? Everybody is almost protecting whatever business they're part of, investment they have. They're trying to sell why they're right and maybe don't worry about it, or do worry about it. But the reality of it is nobody knows 100% what's going on because we've never been here before. So let's continue. So then 2024 projections, what's next for the U.S. economy? They did a survey to find out who thinks a recession is coming. The Fed staff says 0% there's not going to be a recession. I remember they're in the business, so they're supposed to be saying that because that is Wall Street, right? Yield curve says 61% chance a recession is coming next 12 months. Economists are at 48%. Consumers are at 69%. That's Main Street, you and I. Goldman Sachs is saying only 15%. Bank of America, 35 to 40%. But look at CEO, 84%. Okay? C-suites are saying 84%. Now, what would CEOs know that the rest of them don't know? Maybe they know their debt payment. Maybe they know when their debt payment interest rates that they got was lower. That if they have to renew the debt that they got, it's going to go up here. How the hell are we going to make those payments? Maybe we ought to look at what some of these CEOs are talking about. You'll notice the percentage of S&P 500 companies citing keywords on earning calls. What words they're using fewer times. Inflation has decreased. Material costs decreased. Economical slowdown decreased. Job cuts went up, but it's also decreased. So could this be a sign that everything's going to be okay? If yes, why are CEOs at 84% saying a recession is coming? Are they Houdini? Are they Nostradamus? Are they somebody that can predict the future? What do they know that the rest of the people don't?
First, let's talk about why Patrick Bet-David believes a market crash is looming. Look at the signals: rising interest rates, growing economic instability, and the ballooning debt crisis. All these signs point towards a market correction that could shake even the most seasoned investors. Patrick Bet-David isn't just making wild predictions. He's looking at the data, the warning signs, and what history tells us. Remember the 2008 crash? Many experts saw it coming, but few prepared in time. Bet-David's message is simple: Don't let history repeat itself. Be ready. Patrick Bet-David emphasizes one crucial point: diversification. Let me break it down in simple terms. Imagine you have put all your savings into one single stock. Let's say it's a tech company that everyone is raving about. For a while, it might seem like a fantastic idea, especially if that stock is climbing and giving you great returns. But here's the thing: all investments come with risk, and putting all your eggs in one basket means you're exposing yourself to that risk entirely. If that tech company suddenly faces a scandal, new regulations, or a downturn in demand, its value could plummet overnight. When that happens, your entire portfolio could be wiped out, leaving you with nothing. Now, what if you spread those investments out a bit? Say you have some of your money in stocks, tech, health, and consumer goods for variety, some in real estate, some in precious metals like gold and silver, and maybe even a bit in government bonds. Suddenly, you're in a much better position. If one sector takes a hit, like tech stocks dropping, you've still got investments in other areas that might not be affected at all or could even be benefiting from market conditions. This is what we mean by cushioning yourself from major losses. Instead of your entire portfolio crashing, only a part of it might be affected, allowing you to weather the storm without a total collapse. Gold and silver, in particular, are considered classic safe haven assets. These are tangible resources that have intrinsic value, which means they tend to hold their worth even when everything else seems to be falling apart. In times of crisis or inflation, people flock to precious metals, pushing their value up. Unlike company stocks, gold doesn't have quarterly earnings to miss or a product recall to worry about. It simply exists as a store of value. This makes it a reliable hedge against economic uncertainty. Real estate is another powerful tool in your diversification strategy. Real estate isn't just about buying a home. It's about creating an asset that can provide a steady income stream. Renting out properties means you can benefit from a more consistent cash flow, regardless of what's happening in the stock market. In times of market volatility, people still need places to live, and rental income can provide stability even when your stock investments are fluctuating. Real estate also tends to appreciate over time, adding another layer of potential growth to your portfolio. The ultimate goal here is risk reduction. By spreading your investments across different asset classes, stocks, real estate, precious metals, bonds, and possibly even cash, you're ensuring that your portfolio is not overly reliant on any one area. You're prepared for different scenarios. If inflation spikes, your gold investments could rise. If stocks do well, your equities provide returns. And if there's a crash, your real estate can still generate income. Diversification is about not just surviving in volatile markets, but actually thriving by positioning yourself smartly across the board. This is the key to building long-term wealth while minimizing the bumps along the way. But diversification alone isn't enough. Patrick Bet-David emphasizes the importance of having a plan, a clear, actionable strategy for handling whatever the market throws at you. Let's face it, market dips and crashes aren't just possible, they're inevitable. The question isn't if they'll happen, it's when. And when they do, will you know exactly how to react? This is where having a plan comes into play. It's about more than just spreading out your investments. It's about being ready to act decisively in the face of uncertainty. For instance, when the market dips, what's your game plan? Will you view it as a chance to buy undervalued assets, those golden opportunities when prices are low and you can grab high-quality stocks at a discount? Or will you take a more cautious approach, perhaps reducing your risk exposure or reallocating your assets to safer investments? It's easy to get caught up in the emotion of the moment, panic selling, fear buying, but if you have a well-thought-out strategy in place, you can avoid those knee-jerk reactions that often lead to poor decisions. Having a plan also means understanding your financial goals and the timeline associated with them. Are you investing for short-term gains, or is your goal to grow wealth over decades for retirement? Knowing your time horizon will influence how you react to market downturns. If you're in it for the long haul, then a dip in the market can actually be an advantage, offering the chance to buy more shares at a lower price and average down your cost. If you're closer to needing your investments for major expenses, like buying a house or retirement, you may need to consider reallocating to safer, less volatile assets to protect your capital. Think about it this way: if the market tanks tomorrow, what would you do? Without a plan, most people panic. They see the red numbers, fear sets in, and they sell off their investments, often locking in losses. This panic is what turns a temporary dip into a permanent financial setback. But if you have a solid, pre-established strategy, those same conditions can become an opportunity. You could calmly decide to hold your positions, knowing that the fundamentals of your investments are still sound, or even buy more of your favorite assets at bargain prices. Essentially, having a plan transforms you from a reactive investor, swayed by the market's chaos, into a proactive one who seizes opportunities. It's also about understanding risk management. Part of your plan should include deciding how much risk you're willing to tolerate. If you know that a 20% drop in your portfolio will lead you to panic, then you might want to adjust your allocation to be more conservative from the start. Your plan should reflect your personal risk tolerance so that when the inevitable downturn happens, you're emotionally and financially prepared to weather the storm. Patrick Bet-David also stresses the value of contingency planning. What happens if things really go south? For example, if we see a significant recession, you should have an idea of how to adjust your investments. Will you shift into even more conservative assets like cash, gold, or bonds? Will you ride it out with confidence in your diversified portfolio? Having these decisions pre-made takes the guesswork and emotional turbulence out of the equation when things start to look uncertain. Ultimately, a plan isn't just about making money, it's about preserving your peace of mind. The market can be a roller coaster, with ups and downs that can be emotionally draining. But if you're already prepared, you can stick to your plan with confidence, even when others are panicking. This is how you not only protect your wealth but also grow it over time. It's the difference between being a victim of market movements and being in control of your financial future. So, as Patrick Bet-David advises, don't just diversify, plan. Be ready to face the unexpected and turn it to your advantage. Now, let me ask you, do you think a market crash is inevitable? And if so, how are you preparing for it? Drop your thoughts in the comments below. I'd love to hear your take on Patrick Bet-David's predictions. Remember, preparation is key. Diversify, have a plan, and most importantly, don't get caught by surprise. Patrick Bet-David has warned us, and now it's up to us to take action. Subscribe for more market insights and strategies, and let's face these challenges head-on. I'll see you in the next video.